BSE Capital Goods Index has generated a return of about 43% to become the best performer amongst all the sector indices. Since COVID lows, it has gained about 246%, outperforming the sensex by 100%. Individual companies such as CG Power and HAL has done even better compared to sector index. Let's try to understand the reason behind this massive outperformance by the capital goods companies. India's capital goods manufacturing industry serves as a strong base for its engagement across sectors such as engineering, construction, infrastructure, consumer goods, amongst others. The strength of the sector is tied to the economy, with manufacturers thriving when the economy is good and struggling when it is faring poorly. Their performance is indicated by gross fixed capital formation, also called as GFCF. GFCF is a portion of GDP. Higher the portion, better for the capital goods companies. In FY23, GFCF was estimated to be 29% of GDP, up from around 27% seen in FY21. But the GFCF seen currently is not as high as the GFCF about 36% witnessed during 2003 to 2008, a period of boom for the CAPEX cycle. Interestingly, in 2003 to 2008 CAPEX cycle, only 3 to 4 sectors such as oil and gas, thermal-based power generation and metal led the momentum. The current CAPEX cycle is driven by railways, defense, power, green energy, logistics, data centers, automation and digitization, which seems to be highly encouraging for the capital goods sector. Even the government has taken the position to drive the CAPEX. The ratio of central government CAPEX to GDP, which was at 2.9% in the budget of 2022, has increased to about 3.3% in this year. This ratio averaged 2.6% in 2003 to 2008 period and 1.7% in 2011 to 2019 period. When it comes to individual companies in the sector such as ABB India and Siemens have been among the best performers, seeing 30% and 35% jump in their order inflows during calendar year 2022. EPC companies such as L&T, KS International and Kalpataru Power saw a record inflow of order in the last 1 year with the increase of about 20 to 40%. These companies have order book to FY23 revenue ratio in 1.76 to 3.2 times range, showing strong revenue visibility, and further, defense theme also appears to be gaining traction due to higher government spending. In addition, the introduction of new type product or device could mean expansion for companies in the capital goods sector. For example, fully electric cars will require the build-up of many more charging stations to allow these vehicles to operate on a scale of a gas-powered vehicles. Machinery used to create charging equipments need to be produced. Some charging stations are built with their own power sources such as solar panels and wind turbines. Increased demand for those components can boost in production for the capital goods sector. As more stations are needed to fulfill the demand to charge electric cars, more machines to make such equipment will be required at an increased pace. Increase in government and private CAPEX spending, rising infra spending indicate a good time ahead for capital goods companies. Adding to this, corporate balance sheets are strong today compared to previous cycles, which will work in their favor.